points for the audience. If you have any questions for our panelists, please use the discussion box on screen and we will try to get through as many questions as we can during the session. But first, to kickstart this conversation, Jochen, I'm going to turn to you. DLT is a broader technology solution among many, and we have seen changes in the back-end infrastructure happening regularly with the arrival of RTP solutions and broadening access. From your perspective and that of the Bundesbank, where does the use case for DLT fit in? Is it around tokenization of securities on one leg and CBDC on another, or do you see it in any other area?
Before I go to the use case, let me briefly, point out how central banks are being challenged by DLT. It's not only new, it's also evolving very fast. Things evolve so fast in this field, it's almost impossible, to follow the discussion. And central banks, of course, we have to analyze, we do have to, take utmost care and, do due diligence when and if we consider CBDC. And we're doing this both in a retail fashion, i.e. retail CBDC for the general public. We have to look at this and we have to look at it from different angles, and also for wholesale CBDC to be used by financial institutions. And in the communication of central banks, of course, you could see how we were shifting from an initial skepticism towards a more open, towards a more, embracing view of CBDC. And the BIS Innovation Hub will analyze CBDC, and probably I do not need to introduce the BIS Innovation Hub to this audience, but this is where central banks meet, and this is where we want to, combine and coordinate our thinking. And the Basel Center of the BIS Innovation Hub has come up with the project Helvetia, which is, a very good use case for wholesale CBDC, i.e. using it in DVP settlement of securities, and in this case, securities tokens. And the Hub Center in Frankfurt, Paris will also open soon and also dive into this. And now let's look at the use cases. And this, one use case, DVP settlement of, securities transactions clearly sticks out. This is a use case that has some history of exploration, and also the Bundesbank did various versions of its blockbuster series in the DVP settlement. And here I can tell you, the proof is in the pudding. It's not so much to find a pilot solution that works extremely well, that scales well, that looks almost good to go on a cloud environment specifically dedicated to DLT. However, things look increasingly and exceedingly different if you bring your DLT solution into the ordinary production environment, in what you have at your data center with client servers, mainframes, firewall, you name it, we have it. So making this work in a regular production environment is a completely different challenge. And this is where I think, more research needs to be done. And when we speak of use cases, we have to generalize, DVP settlement of securities. This is also, DVP settlement of any asset token, of anything that can be tokenized. And of course, a very promising use case is programmable money or programmable payments, i.e. have a smart contract or any other, blockchain application agreement whatsoever, execute a payment without any further intervention by a trusted party. So this is for me, the new use case that could open new business models, and the new business models being pay per use, pay per unit, pay per, microsecond. Normally, the administrative burden kills those use cases. But with DLT, we have a chance to make that use case work. And with CBDC, we have a chance, let's say, to make it also DVP. And we are very practical at the Bundesbank. We do not only think to link, let's say, such use cases, such smart contracts with CBDC, we are also actively thinking, and we have done a pilot testing for this, to link a smart contract with classic payment system, in our case with Target 2, so that a smart contract could trigger a Target 2 payment, confirmation of which, let's say, goes back to the chain and therefore is not exactly DVP, but it's conditional settlement. It's DVP 1.1, I would call this, and it works very well. We have experienced this in securities, let's say, long time ago, where we do overnight settlement in this DVP 1.1 fashion. So it's doable, it's a good solution, and it has the beauty of being, let's say, ready on the spot. You can use it now because you don't need, let's say, to change any law or regulation, and you can use it now because it works in the production environment. Does this answer your question?
It does. Thank you, Jochen.
Okay. Thank you.
Laura, just turning to you, building on some of Jochen's comments here, he's talked about the use cases, but just taking a step back, could you maybe outline some of the issues and maybe some of the specific pain points from an industry perspective for payments and settlements before we start looking at all these different instruments? So whether that's in post-trade settlement, regulatory compliance, or verification, for example.
Sure. Well, thank you, Bhavin. I think the global payments via the traditional banking model has been around for many, many years, right? And the model was associated with the inefficiencies and pain points arising from the complexities of payments flowing through several intermediaries. So if I was just to address the frictions on the payment side, I think these can be largely bucketed into a few key areas. Well, firstly, you have the lack of speed because payments have to go through multiple hops, which requires sequential processing. And then there's the dependence on operating hours, payment cutoffs, and holidays of different banks. Then you also have the lack of fee transparency. Each bank can charge a different fee, and often these fees are not visible to the client prior to the initiation of a payment. There's also lack of certainty that payment will succeed due to issues with missing, inaccurate, or incorrectly formatted transaction details. And all these takes time for the banks to check or reconcile, and really because each bank maintains very different ledgers. Today, there is limited automation involving corporate fund movement with bank accounts, and this is largely due to the lack of standardized tools. A lot of these services do not interoperate, and as a result, this limits what we can do with payment and makes transaction costs go up. However, we recognize that correspondent banking remains the most ubiquitous model for the interbank payment and settlement globally. The complexity of this model, accompanied by divergence in regulatory standards across multiple jurisdictions, adds to the overall costs associated with cross-border payments. So to me, finding the right approach to payments transformation using innovative and new technologies is a priority. And doing so, I think, can fundamentally transform our existing infrastructure. Hopefully that gives a quick and succinct summation of the problems that the industry is facing.
Thank you. Mark, just maybe given your commercial bank perspective, anything to add there, and maybe homing in on one of the major pain points that Laura's already mentioned: cross-border payments, cross-assets, different payment networks, and maybe the liquidity Jenga that you might need to be playing here. I can imagine the interoperability challenge in connecting to many of these different digital currencies that will eventually come online. Could you maybe explain the importance of possibly being on the same network, if it is important, the transparency across payments chains when it comes to cross-border payments?
Well, thank you, Bhavin. That's a hell of a question there. I'll go through it.
That's why it's for you, Mark. You saved that one for you.
Thank you very much. Look, I'd like to pick up on a few points that Jochen has touched on, and also Laura. I think we're at a really interesting point in history in that we have this new technology, a new tool, which is distributed ledger technology or blockchain. And from a business perspective, that offers us some really interesting benefits. And that is transparency around the different stores of value that are held on DLT and blockchain. Workflow, so as both Laura and Jochen have mentioned, whether it's trigger chain, whether it's programmable money, we're able to listen into the stores of value on blockchain and then process them accordingly to workflow. And you can see all of that within a blockchain and DLT. And then there's audit trail. So some of the aspects that Laura was talking about in relation to where is my payment? If everyone's on the same network and subscribing to the same DLT and blockchain, you can see where your payment is from time of execution through to time of settlement. So I think using those sorts of design paradigms, you solve for a lot of the challenges that are being described. At HSBC, we've implemented a DLT solution over 3 years ago called FX Everywhere, and we've implemented that across 18 different balance sheets and 18 different currencies, and it provides us just that. We put $2 trillion over the platform, so it's something that we use on a daily basis and have stood up. So it gives us that transparency workflow and audit trail of our cross-border payments and FX payments between the different entities. So I think there is a way to move forward in that. As both Jochen and Laura have said, we're pretty new in this journey. The challenge will be when we start looking at different digital currencies and assets, and we're looking at the rate of exploration, innovation, all these different activities which are going on. And as Jochen said, it's hard to keep up with what's going on a daily basis. The challenges for a commercial bank, and thank you, Laura, for saying that correspondent banking is important in cross borders, because it is, because we have the license to pay with the central banks, we have access to the RTGSs, etc. So we play an important role in moving towards this new world. What the challenge will be is the different rates and different design paradigms that the central banks are looking at. So whether it's going to be token based, whether it's going to be account based or digital wallet, whether it's going to be retail, whether it's going to be wholesale, whether it's going to be domestic or cross border. So you've got this really interesting Rubik's Cube of a solution that we need to try and solve for. And then for commercial banks such as HSBC, we're going to have to connect to 60 plus of these central bank digital currencies if, as, and when they come online. So how we solve for that, we think that DLT will play a role. It won't be the only tool within the toolbox that we'll use. It'll be part of the architecture and it'll probably overlay existing solutions. So to Jochem's point, you want to enhance and complement existing investments in infrastructure that are in the globe, that is used across the globe. And then as to the network effects, if you look at some of the more successful implementations around that FMIs provide, for example, then having people using an FMI as a traffic cop to help coordinate the payments between the different entities that are accessing that network, we think that's important too. So that once you have that traffic cop, then you get standards, then you get a set of technologies that people are used to, you have a rule book that people adhere to. So we think that's a good way of unlocking some of the potential in adopting new digital currencies and assets and new technologies.
Thanks, Mark. David, just turning to you, today's discussion is on DLT applications, so the technology does need to be mentioned here. Is this all technology driven, first of all? You've had experience with eCash, DLT, and asset tokenization, working with Laura and Temasek, as well as SGX on some projects as well. So what are your thoughts here with working with this technology and the features of DLT, and are they well suited to the use cases that you experimented with?
Yeah, that's a great question, and I love speaking about technology, so it's perfect for me. I think that technology is definitely driving the art of the possible in e-money applications, and one of the key drivers for that, although obviously the whole of the DLT tech stack is very interesting, is definitely smart contracts. The ability to be able to tokenize elements or to be able to define data in a dynamic way via smart contracts means that you can build up new business models that make, for example, the bond system that was done in the SGX project possible. And this is a completely new paradigm that hasn't been seen before. So I think that is very interesting. So building up new business models based on new technology that's taking the market. I also think that it's not just about the smart contracts, though smart contract languages like DAML or Solidity or others have a big role to play. But the underlying ledgers, shall we say, that support the smart contract language itself are evolving, and they're getting more scalable and more secure. So what we're seeing is things, ledgers like VMware or Corda, for example, are having a big role to play in this new world, and also the integration with them and hybrid applications, possibly using cutting edge technologies such as like AI and big data, and also integrating with existing systems like Jochen mentioned previously, are creating completely new use cases, and being able to basically get these out of the lab and into production, which is really important, I think. So I do definitely agree that technology is a driver for new use cases and for the building of new business models.
Thanks, David. Laura, back to you again. Is the technology just solving today's problems, or is it about gaining new net capabilities to the system? So you've mentioned already the additional utility we can add to new systems through smart contracts, programmable money, PVP, DVP. But as David just mentioned, it's about getting it from the lab into production, and you've, with your experience, have seen that. So any thoughts on that?
Well, this topic is quite timely, Bhavin, as yesterday we've just announced that Temasek is partnering with both DBS as well as JP Morgan to establish Pateur, a platform which has the potential, we think, to transform interbank value movements through developing an open technology infrastructure. And we believe that this has potential to change the way payments are traditionally processed, to enable atomic or instantaneous settlement, which would then make cross-border payments, conditional payments, foreign exchange settlement simpler, easier, and faster. Now, I believe that using innovative and new technologies, such as shared ledger and smart contract technology, can fundamentally transform our existing FMI. I see this as an opportunity to drive both innovation as well as competition. So Pateur's eventual goal of creating a platform for digitized commercial bank digital money with enhanced programmability, immutability, transparency, and immediacy of global wholesale banking transactions, we feel it will reduce or eliminate some of the current pain points and associated costs in the traditional model, which I've spoken of earlier. And we believe that this will be beneficial for all market participants. We think that this will also spur innovation in next generation programmable value transfer for participating banks as well as their clients. Mm-hmm. And it could also further unlock greater efficiencies throughout the value chain. Now, over time, we kind of hope that we could continue to innovate and expand our service offerings to other markets and in various currencies, and to provide essentially 24/7 infrastructure to enable financial institutions and developers to co-create applications that support use cases that you just mentioned about, Bhavin, FX PVP, DVP, peer-to-peer escrows, whereby the current payment infrastructure is currently unable to support. And that's where we think the next generation rails will start providing net new capabilities to transform your current existing financial market infrastructure and potentially enable next generation programmable value transfer.
Thanks. And Jochen, maybe you have anything to add there with your experience. You've already talked about a few with the Bundesbank. Where exactly are we likely to see greater functionality and additional net capability?
Let me be the party crasher here in some way. And in our experiments, we saw that the savings, the big, let's say, gains in efficiency are in very humble and mundane tasks, such as reconciliation, such if we talk about, let's say, securities, we talk about custody services, we talk about corporate actions, i.e., I would expect, let's say, the big savings to come, let's say, more from the asset, from the smart contract side of things. The classic payment system, the payment bit, is already very, very efficient. And this now comes to party crashing. The pain points Laura has, let's say, neatly lined up, which are all true. For my taste, they are not related to technology. They are related to regulation and to business processes which of course, let's say, follow to the regulation, but also follow tradition. Let me give you an example. You're probably familiar with Ripple. You've heard of Ripple, and you're also familiar with SWIFT GPI, Global Payment Initiative. So what links the two things? Well, before Ripple, the cross-border, let's say, correspondent banking was a nice place where liquid lunches still, let's say, could be done, and where the flow of business was, how would you say, steady, and the margin was good. Now enter Ripple, who sees that margin and says, I can do better. And in order to make it sexy, I come up with, let's say, the Ripple currency and the Ripple chain. What was the reaction of SWIFT and the community? Well, we say, okay, now let's see whether the classic technology cannot deliver the same. And the answer is yes, it can, because the problem was not the technology, it was the business process. Does a correspondent bank need to sit 2 days on a payment? You can ask that question. And if your answer is 20 seconds would be sufficient, here we go. So I think it's, let's say, more a question of regulation and of business processes. And business processes often follow traditions. They could be overhauled, they could be renovated. It's not so much the technology, but technology is a very good excuse. It's a kind of the can opener, where, let's say, you shake up the complacent folks in the commercial banks, in the central banks, and you get them to work. In that sense, let's say, technology is needed as a driver. Yeah.
Thanks, Jochen. We have a question from the audience. I think this one can be directed at Mark. We just talked about cross-border payments here. It says, do you want central banks to design their CBDCs to perform better cross-border? And does it have to be from the central banks?
Well, the central banks, and I'm sure Jochen will chime in on this, the central banks work very closely with commercial banks. And if you look at the models that have been adapted across the world, whether it's indirect or direct, it's indirect. So that money supply chain that's been reimagined is between central banks using commercial banks as a distribution point into the broader ecosystem and network. So we need to work together. We're fortunate that there's lots of innovation and lots of catalysts for change in the marketplace that is forcing us to think about new business processes, technologies, and how we reimagine that business process. So we have this buffet or smorgasbord, depending where you come from, of choice when it comes to how we go into the marketplace with this new form of currency and digital assets, and improve the PVP and delivery versus payment experience for our clients. So it really needs to be a strong collaboration and partnerships between central banks and commercial banks, and also the different technology partners that we can use in order to achieve the business outcomes for not only ourselves but also our clients.
I can only support Mark here, because a currency is not only a set of distinct regulations, it's also an ecosystem of, let's say, players, and commercial banks for sure play a very important role. And this is also what makes it so difficult for central banks. Usually, if you look in the charter of a central bank, its primary obligation is monetary policy in one given currency. In our case, in the euro system, it's the euro. This does not mean we do not care about US dollar or the relationship between euro and US dollar, but the clear prime responsibility is the euro. And therefore, the cross-border dimension and, let's say, the cross-currency aspect from a central bank looks different than from a user. And so far, we have organized our world very neatly. We have everybody is minding his own business, his or her own currency, and the gates between the currency, let's say, they are precisely defined, they are well managed and, let's say, closely controlled. And now you have those nasty upstarts that come and say, no, we can do this in one platform. We don't need your controls and your gates anymore. Let's have, let's say, one financial market. Let's forget about the differences, the subtle differences between the currencies. This is a kind of a different view of the world. I don't know which view of the world is, let's say, the right one or the prevailing one. But from a central bank perspective, it's clear we have to move carefully and tacitly in such an environment.
Yeah, it's taken central banks and commercial banks well over 150 years to build up this ecosystem safely, with the appropriate rules, regulations, connectivity into different payment systems, and to be licensed to pay. So as when we're bringing these new participants into the marketplace, we've got to ensure there's a level playing field as well. So if you want to participate in this this new ecosystem and environment, then there's rules, regulations, roles and responsibilities that you need to adhere to in order to participate. So as Laura and David have been saying, whilst there's been some really good innovative thinking and experiments, that should be part of the overall mix, but we should be careful in how we bring those different experiments into production. And that really needs to be a joint effort between the different participants in that ecosystem.
Yeah, and maybe I could make one clarification as well. So for Patel, unlike some of the certain blockchain projects, right? Our mandate is not looking to create a new type of money, but rather we would like to use the blockchain to more efficiently settle and clear commercial bank money. So this is M1 money. So it's very much in a way of how to use existing relationships and liabilities that are that exist today.
Yeah, agreed. And that's precisely what we've done at HSBC. We're not looking to reinvent. We're looking to overlay existing processes and settle fiat money. And using the new technology, that provides a whole bunch of new opportunities for us around the way we manage cash capital and collateral.
Thanks, Mark. Just want to move to David. And before we move the conversation to private consortia and walled gardens, we probably need to distinguish the design paradigm of the blockchain network a little bit more between public and private. We are seeing many different solutions based on both of these types. So I just wanted to ask, could you define both of these for us and possibly where both of these types of networks are seeing their concentration in use cases? And Laura, I'll turn to you after that.
Public networks, as their name suggests, it's basically a public network. It's permissionless, anyone can spin up a node, and generally they have a distributed governance system. So that means that the rules that they're governed by are determined by the network itself. Some popular networks might include, for example, Tezos, Hedera Hashgraph, obviously Bitcoin and Ethereum. Private permissioned blockchains are set up by either usually a single organization or a consortium of participants on the network. In some ways, they're more flexible, so you can architect them in different ways. So you don't need to use the same architecture as a network which is already set up and deployed. There's obviously a lot of different options in this market, but some of the ones that have been more used in the enterprise space, we've spoken about them before, are Corda, VMware, and Hyperledger Fabric. So generally, though it's not always the case, public networks seem to be, at this point, being used for more B2C settings. So, for example, NFTs or some tokenization systems seem to be using the Ethereum public network or Tezos or even Hedera Hashgraph network more than B2B. So in B2B, it seems that people are it seems that private blockchains are being used more often. It might be the case that people don't want to host their data publicly. They might have data localization requirements as well, so they can't take their data, for example, outside of their country. It might be the case that their ecosystem is dependent on the organizations that are part of this consortium. So once you get rid of those organizations, well, it doesn't make sense to actually have the network itself. So I suppose that, generally it's a B2B setting. One of these is for example, the the project that Jochen mentioned before with the Bundesbank, the Blockbuster project that GFT were also involved in, where you have where you actually had two different private networks, one which was on the Bundesbank side, and the other one which was on the Deutsche Börse side, which we were managing and building. And they were actually interconnected by like a transaction coordinator. So we see that a lot of the time when we're talking with organizations and when we're working in the enterprise space, that a lot of the time it's in the B2B space, and this seems to be more on the private side. Another thing to maybe bear in mind is a bit of a nod to some of the hybrid solutions that are coming out at the moment. They're pretty new, but we're seeing things like Chinfin and Orbs, which are starting to bring hybrid solutions to the market.
Thanks. And Laura, maybe just is there any considerations for interoperability between the systems that we need to take into account, both on the technical technology level and the legal regulatory level, perhaps?
Definitely. I mean, a lot of times I think we use interoperability very loosely and very easily when we say, for blockchain platforms, we need interoperability. But how easy is it to achieve interoperability? I think not many people have managed to crack this code yet, right? I think it's a discovery process that needs to happen. But I'm also very confident that, with so many bright minds, out there and so much money thrown into this space, I do believe that the solution will be found. But right now, I think it's still a lot of research is still underway in this space, right? And I think I'd like to further add on to what David has just mentioned, right, about the public space as well. Blockchain to me is like more than just banks and cryptocurrency or even digital assets, right? The technologies can also be applied to create digital signatures, digital certificates. It also can be used as infrastructure, for identity attestations, right? So digressing a little bit from, I know this is like, a banking conversation, but digressing a little bit, on this front, Temasek has also founded Lemma Tree, comprising of like Affinity, Good Worker, and Trustana. Affinity being the core technology provider and uses decentralized technologies to develop self-sovereign identity solutions. And we have also built like 2 applications on top of it, Good Worker and Trustana, that uses Affinity's technology. So Good Worker is a job matching platform that connects blue-collar workers and potential employers in India. And you have also Trustana, which is a curated cross-border B2B marketplace that connects buyers and sellers, right? Last but not least, we've also initiated a project to enable travelers to receive COVID test certificates on their phones and present them to relevant authorities with the assurance that these certificates are tamper-proof. So I do think that in totality, blockchain is helping businesses, bringing them efficiency, enabling authenticity of digital credentials, and not just the hype of cryptocurrencies, Bitcoin, even digital assets, right? There's a lot of tangible use cases out there, beyond the banking world as well. Slight digression, and back to the banking world now.
Thanks, Laura. Mark, one of the ways that DLT is brought to the market is via consortia with more and more digital assets and currencies experiments that use DLT as part of the architecture. What lessons can be learned from successful consortia propositions that have moved to production, specifically as the financial service industry transitions to new digital asset? What considerations need to be given for roles and responsibilities, governance, interoperability, fungibility of private settlement tokens, or a lack of clarity of who owns the risk in the system? It's a big question, but I think you can handle that.
Yeah, I seem to get the longest questions ever, which is great. Again, I think it just highlights some of the topics that we've discussed here. I think that one of the bigger challenges will be for the broader financial services ecosystem is how do we transition from the heritage to new world or heritage to digital. And so that transition is going to be really, really important, and how we move towards the new world, I think, is going to present everyone with some new challenges. So if we think about onboarding 60 plus different central bank digital currencies, for example, think of how much disruption happened when we onboarded euro. So to do that 64 times or 60 plus times is going to cause some challenges. So to have the roles and responsibilities and a rule book and an FMI or a traffic cop that help stands up the the way that we transition to the new world, I think will be really helpful. I think also, as we've discussed, there's some really good catalysts for change, and there's some great experiments going on across the globe, and that's all really great. I think once we get through the hype and noise of all of that and start to settle down a bit, and we start to settle on, here is the services that we need in order to transition to this new world, then I think that will be helpful too. And if we're able to settle down on a few different solutions that will help us, and just from a service level, whether it's insert name of company solution here, doesn't particularly matter. But if we're looking at how we create a tokenization platform, or a digital vault, or a post-trade FX payment versus payment, or a trigger chain solution, if we've got that solution stack, then I think how we engage with these different ecosystems will help us transition too. But we've got to be mindful of ensuring that we're overlaying the existing investments, infrastructure, and solutions to pivot to the new digital world. So again, we're fortunate at HSBC that we have a lot of those different components. As you've seen with the SGX experiment recently, we're able to tokenize bonds, we're able to store them, we're able to pay them. So we do have that. But again, the interoperability point that Laura mentioned is important too, because how you interoperate between the new and the old, I think, is going to present us with new challenges. And that could be as simple as an API with a business rules engine that tells you this is how we're going to connect into it. For example, the trigger chain solution that you've talked about, Jochen, or it could be a bit more complex where we're putting a token in between to move between the different solutions. But I do wonder if we're putting tokens in amongst all of this, whether we're going from PVP to PVP-VP, or if we go from DVP to DVP-VP. So putting another P in amongst all of this may not be the best way. But they're things that we need to experiment and we need to work through as an industry. And consortia can be really helpful, again, as Laura said, because there's a lot of really intelligent people who are looking at this problem, and it's better together to solve these problems rather than trying to do it individually.
Thank you. David, anything to add on consortia? I know that you've had some experience here as well. I think
I would just say that, I think definitely consortia are hard to put together. So you need to have a real use case if you want to put together a consortia. So I remember that we've worked with SIA for a long time. They're a partner of ours. They have been for a number of years, and we worked on them on their first blockchain consortia back in was it 2016? And I remember, because I was very involved in that, the creation of the actual application itself, maybe, I don't know, the development took 6 months or a year or something like that. But the periods of space between the POC, the MVP, and the production rollout was maybe like 6 months or even a year between them, because it was the creation of this consortia, and that took a lot of time because it took a lot of people to be able to put their name on the contract. It took a lot of organizations to make sure we had the right banks involved. It took a lot of convincing, and the reason that we did manage to get that convincing, and in the end we managed to get a consortia, I think it was like 4 of the main Italian banks for this particular project, was because the use case was actually something that they needed to roll out. So if there is a use case that is completely relevant, solves a problem for these banks, and they need to work together, or financial services institutions more than banks, or even companies, then they will create a consortium and work together. If the use case isn't strong enough to be able to create a consortia, then they're not going to. But in the case of programmable money, everybody needs to work together. So I think we definitely will see consortias coming together about this.
Yeah, just to add to David's point, use case and client outcomes is absolutely key. So we've got to make sure that you consolidate around a use case and what those outcomes are going to be, rather than, hey, I've got a fancy new hammer and it looks like a nail. So you've got to make sure that you're coalescing around a business and or use case that makes sense and that everyone buys into. And also, just to echo some of the points that David said, it's hard to get one bank to agree to do anything, to get a dozen banks to agree to do anything is equally as hard. So you need to be mindful around having that vision or that goal that people are saying, okay, here is a use case, here's a business outcome that I'm really interested in, and therefore I'm going to put my shoulder behind this.
Thanks. Jochen, sorry. Laura, did you have it?
I was just going to echo that. I completely agree with Mark here. I mean, we've seen quite a few announcements over the couple of years, the past couple of years, whereby, there was a lot of consortia events that people sign up to, but after that, just disappears in the deep blue sea, and you're wondering like, hey, what happened to it, right? So I think the right motivations, right, and identifying utility, right, and the right use cases is of critical and paramount importance, right? I mean, Temasek is not one that likes to just sign up, just to get your name in the press. We're generally very low key. So we do believe that, when we do sign up for something, it needs to have an impact. It needs to be able to solve real business problems for people. So I agree with you on that point, both David and Mark. Brilliant points.
Thanks, Laura. Jochen, again, just back to you. Just wanted your reaction on the BOE announcement with Finality. We have Finality later, straight after this session, talking about this announcement. But what does this mean for FMIs? And does this change anything? Would a consortium-based group change the conversation for Target 2, for example? Will it be overseen in the same way? And could it offer more opportunity or possibly introduce some new risk as well?
Okay, Bhavin, I would need to come up with a disclaimer here first, because the conversation for Target 2 is essentially a Eurosystem conversation.
Of course.
So I could only give you, let's say, my personal take on how this conversation may evolve, let's say, after the BOE announcement with Finality. And of course, we have started looking at Finality, and Finality has approached the Eurosystem. And my first observation would be Finality has undergone quite a few changes in its design since its inception as utility settlement coin. And there is a fine balance between enabling new business models and mitigating the risks that are, let's say, included in this. And from a central bank's perspective, I would take the vantage point of financial stability. And from the vantage point of financial stability, I see risks when wholesale payments are being settled outside the gates, or I should replace gates with outside the RTGS systems of the central banks. It could be harder to oversee the risks in those outside systems. And please bear in mind, we are the underwriters of the liquidity to be used in those systems. And furthermore, there may be risks in broadening access to central bank money. So far, let's say, we are managing the world of central bank money with restricted access. We restrict access to monetary financial counterparties, which is shorthand for, let's say, for banks. And there are reasons to do so. We also restrict access to, let's say, utilities, to financial market infrastructures. They have to fulfill certain criteria in order to, let's say, settle via our systems. And I'm afraid that, let's say, by opening up to consortiums like Finality, we would perhaps enter into a discussion whereby the broadening of access to central bank money goes beyond the reasonable. And therefore, I would favor a very cautious approach here by the Eurosystem. And when it comes to oversight, I guess, let's say, any payment system that is becoming systemically relevant will be overseen, and will be overseen, let's say, in a risk-oriented fashion. And of course, Finality will be no exception to this rule. So level playing field, yes, and level playing field in this perspective means, let's say, risk-oriented oversight.
Yeah, just to complement what Jochen said, I agree. I think that there's two sides to this argument. There is the innovation, experimentation, and thought process around this. but I think we need to be thoughtful around how these participants act within our ecosystem.
Yeah.
And so when you're looking at things like liquidity and payments, and we're starting to fragment the liquidity and payments even further, we need to be careful around how they're brought into the broader ecosystem. So it's not whether it's right, wrong, good or bad. It's catalysts for change, and it's for us to think about, but also we need to be cautious around maintaining the integrity and the way that we operate in this marketplace. You know, for FMIs like CLS and for ourselves, for example, there is a bunch of fiduciary responsibilities, laws and regulations that we need to adhere to. So ensuring that level playing field is in place is super, super important.
Yeah.
Thanks, Laura. I think this goes quite nicely to you and your experience back with Project Ubin and the MAS. You worked with a number of commercial banks during this project. Maybe you can share some of your experiences, things that we just talked about just now, around liquidity, trust, privacy. Yeah, any thoughts there?
Yeah, maybe just a quick recap on Project Ubin, right, which is a multi-year, multi-phase project led by the MAS, aimed at solving the pressing challenges, faced by FIs or financial industry using blockchain technology. So Project Ubin developed the solutions in 5 phases, or they were trialing and using POCs in 5 phases, right? So the first one was about, tokenizing the fiat currency, specifically the Sing dollar. The second phase, they experimented creating decentralized real-time gross settlement systems. The third phase was to facilitate DVP capabilities of tokenized assets. The fourth phase was enabling cross-border payment versus payment capabilities. And the fifth and final phase that just ended last year was really to create and foster a broad ecosystem of decentralized blockchain-based financial technology. So Partior builds on our past work as part of Project Ubin to explore the application of blockchain technology involving multi-currency payments and settlements. So Project Ubin had demonstrated the possibilities to more efficiently re-architect how financial services can be delivered using blockchain technology. The payments network prototype validated the commercial use case for such a platform, and the establishment of Partior was envisioned to be able to take it to the next stage of commercialization. So the eventual goal for us is to create a platform, like I've mentioned again, for digitized commercial bank digital money, with enhanced programmability, immutability, transparency, all to reduce, the current pain points associated in the traditional model, and we hope that this will benefit all market participants, right? So, for example, although there has also been, emergence of real-time settlement systems globally, with services such as multilateral netting and intraday liquidity products, there are still limitations begotten, by settlement systems underpinned by centralized databases and operating systems. So we think that, with blockchain-based technology, it will enable value movement to be dictated by tokenizing payments and enabling instant transfers, between the banks in the distributed ledger, on the distributed ledger. So one of the potential areas we are looking at is to develop solutions that enable atomic settlement of payments, so that what originally takes days can happen instantaneously. And that is how we think it can make payments cheaper for the consumer. So the faster money moves, the less liquidity is required to be tied up at each end in the correspondent banking chain to execute the payment. And if you see that velocity increases, money required to be held, in the North-South network will decrease. So what this means is that you do not need to have as much trapped liquidity to execute the payment. And that is what we think will help to make payments cheaper. Now, we believe also that, these blockchain-based delivery of these financial services could potentially pave the way for more first-in-market services, as well as create a platform that can work with other emerging blockchain and financial technology. Just to hammer home the point, Partior is not looking to create, a new type of money. What we want to do is to use blockchain to more efficiently clear and settle commercial bank money, or which M1 money.
Laura, I think all brilliant points, and I think it highlights some of the opportunities that we have as a marketplace. And I think the key points there is transparency and network. So those sorts of solutions, as and when they're stood up, and HSBC has been part of Ubin, as you know, so we're a keen participant in it. But the transparency and network effect is when you start to realize those benefits. So as and when these networks are set up and you've got the right sort of participants that are providing solutions into that network and exchanging value on that network, is when you start to realize that value. And the transition to that, again, I think is going to provide us with some interesting opportunities as well.
Yeah, definitely. Yeah.
Thanks, Mark. Thanks, Laura. I just want to spend the last 10 minutes very quickly. We have another session on this, but just bring in the discussion about stablecoins. We have seen, just your quick thoughts here, Mark. Are there risks around the fungibility of these different networks, or even the reserve management of this? We've seen what's happened with Tether, but do they have a place in the financial system?
I get all the good questions, Bhavin. This is great. So with stablecoins, I think as ever, it's important to ensure that we're talking the same sort of language. So central bank digital currencies is a form of payment. It's probably the most risk-free. We've got stablecoins where we've got Libra and USDC and Tether that are being stood up. And that is pegged against a particular currency, and therefore we have a one-for-one value in it. And then we've got cryptocurrencies that have no intrinsic value, and the risk is against the particular owners. So I think with stable coins, it really depends on a few things. So regulation. So we've seen recent OCC FinCEN regulation that is suggesting that stable coins can be used safely. But then you're getting back to the credit side of it. So you need to ensure that the funds are liquid and fungible, that the audits around those funds that are segregated is strong, and that you have a clear claim on them. And the other aspect is the credit risk. So you need to be mindful of the credit risk that's associated to those stable coins. So, for example, if it's Facebook that is standing up behind that particular stablecoin, then if there is a Facebook depeg event, then who do you have the claim against? With central bank digital currency, it's very clear. It's the central banks, and therefore there's reserves, there's tax, there's all sorts of good things that stand up behind that particular currency. So with stablecoins, it is not as clear. So there is that sort of aspect to be aware of. But to answer your question, is there a place for it? Of course there is. But also I think we need to understand what the size of a market is and how much of that particular market is going to be consumed by stablecoins. At the moment, it's small compared to the total value of payments that is going through the broader ecosystem. As we start to move to digital money and money 2.0, as it's been termed in the marketplace, then yes, it will. I think it will definitely be a form of payment that could be used within the broader marketplace.
Thanks. And Jochen, I just want your thoughts here as well. I mean, given they're almost very close substitutes to digital sovereign currencies, anything to add to what Mark said?
Yes, please. And as a central banker, I can take, let's say, two perspectives. Let me first take the very obvious selfish perspective. Let's say a stable coin done well, in particular with the tacit support of a central bank, i.e. the central bank offering to hold the reserves that back up the stable coin, could be a, let's say, very close substitute to, let's say, central bank digital currency. And if I'm saying this, I would rather prefer the original and think, therefore, let's say, such stable coins would not be needed. If we look at stable coins where the credit risk is still imminent, and this was a kind of the better part of Mark's explanation, I would kind of go in two dimensions. I would go in a historic dimension. And in Germany, let's say, central banking at the central level came relatively late. The Reichsbank, the predecessor of Bundesbank, was founded in 1875 only. Until this, we had many marks and pfennigs, many, let's say, local currencies, and the efficiency of this local currency system was not very good. It was really bad. And let's say, commerce was arguing, let's say, for, let's say, resolving this. Also, you can go back into the US, into the famous wildcat banking, where a Boston dollar would be traded at a discount in New York, and probably in California, nobody would even want to touch it in the first place. So this kind of a stable coins with credit risk weighing for payment market share is difficult, because the credit risk spoils the party, let's say, very early in the game. Also, if you look at experiments where we have with local currencies, whereby a local community says, we have enough of it, we want to keep the seigniorage local, we want to make sure that local exchange rates are not affected by turbulences, and you have seen such experiments in many communities. Usually they fail after a while. If you really want to use money, it's a two-sided market. It's a hen and egg problem. Everybody needs to accept it, and everybody needs to trust it. So what does come first, trust or acceptance? No, you have to resolve both issues at the same time. And therefore, I see, how to say, stable coins in this respect with a credit risk, I see them as a play. You can play in that market, you can even speculate, but this is not serious when it comes to payments.
So I think, just to add to what Jochen said, again, let's go back to basics. So we're looking to reinvent the money supply chain. And so that money supply chain will be from central banks to commercial banks, and then there'll be a funnel. The funnel, as we've had to date, has been fairly narrow, and there's been merchants and a few others. We're just broadening that funnel to have different forms of cash and different participants. So if you look at a lot of the stable coins and what they're looking to do, it's usually from a digital wallet to digital wallet transfer of value. Now, typically that's great, and there's lots of commerce that can go between those two different wallets, but ultimately they're going to have to funnel down into commercial banks and into central banks to get into the broader economy, to pay your tax, to go and buy stuff at the shop, to do whatever. So I think you also need to be aware of that. So yes, a useful tool within the broader ecosystem and liquidity funnel, but ultimately they're going to have to come back through to banks' balance sheets and into the central banks as well.
David, you had something to add as well on.
So maybe one thing to just bear in mind is that if you look at the map of CBDCs and you look at how many CBDCs are actually implemented and how much is really just in the design phase, although CBDCs do seem to be being rolled out across the whole of the world, there's not that many countries that are actually in pilot at this point in time. And that's just how it is. But the stable coins are actually available to people at this point in time. So I think we are going to see them as a kind of like stopgap solution that people are going to use. Another thing that I just wanted to mention, as I know that we're in the last couple of minutes here, is that GFT, along with a couple of other partners who are very prevalent in this area, are actually designing and will be developing a solution to be able to provide interoperability between e-money, so like CBDC money, and also stable coins. Because what we see is that in this particular moment, what we're going to need in the next 5 years, up until the point at which actually we have e-money available for everybody, because it's going to be a widespread thing, is payments in all of these different types of money. Yeah, forms, exactly, that's it. So so we're going to be working on that with a number of our partners, and we're actually going to go public with this in the next couple of weeks. So I'd like to maybe say, watch this space, because we're going to be presenting something about that very soon. It should be quite exciting.
Yeah,
Thanks.
David, I think it just highlights that the transition to will be important, and this intermediary state between these different forms of money being in circulation will be interesting. But again, I think it's going to come back to those basics. How do you funnel it through that money supply chain? Because ultimately these new wallets, etc., they're going to be backed by a bank who will be then facilitating payments into traditional payment rails.
Thanks very much, everyone. I think on that final point, that can conclude today's session. Thank you once again for the audience for joining us today, and all the speakers for sharing their valuable insights on this panel. So thank you very much, and we'll look forward to seeing you again soon.
Thank you.
Thank you. Cheers.
Cheers.